As we continue to discuss indirect investments, investors buy, hold, and sell their shares of mutual funds, ETFs, and closed-ended funds. Those shares are purchased in one of two ways. Shares purchased directly from a fund through a company's location, website, telephone, or even the good old-fashioned postal service. And shares can also be purchased from an agent of the fund working through banks, life insurance companies, security firms, and financial planners. The mutual fund market is aggressive in its marketing and has created multiple strategies to differentiate itself through the addition of multiple services and conveniences. Most minimum requirements to begin a mutual fund are small, some as low as $50, and 80% require $5,000 or less. Mutual fund distributions are paid to investors of assets from the fund, including capital gains, the proceeds from the sale of assets by the fund's manager, such as stocks. Throughout the tax year, mutual funds typically distribute capital gains at the end of the year. Dividends. These are income from dividends paid by stocks in the fund's portfolio. And interest. This is income from interest paid on bonds in the fund's portfolio. Mutual funds typically pay distributions monthly or quarterly, but some pay annually or semi-annually. The frequency of distribution depends on the fund's focus and administrative costs. Some funds retain dividends during periods of high income and distribute them during periods of lower income to maintain a consistent monthly distribution. When a mutual fund issues a distribution, investors can choose to receive a check or reinvest the earnings to buy more shares. Cashing out on capital gains distribution reduces the net amount invested in the fund. Most distributions from mutual funds are considered investment income and must be declared on yearly taxes. However, there are some exceptions such as qualified dividends, tax-free interest, and long-term capital gains or timing of the market. When it is time to sell the shares back to the mutual fund in exchange for cash, the funds must execute the transaction. Those exchanges occur at the net asset value per share plus or minus fees, either sales charges for purchases or redemption fees for sales. The majority of funds price their shares at 4 p.m. Any requests to execute those transaction orders before 4 occur on the day of. Any executable orders that are received after 4 p.m. are not executed until and at that next day's share price.